This educational documentary chronicles the complete transformation of Wall Street trading from 1980 to 2025 through the symbolic journey of the trading floor itself, from the frenetic energy of a young trader clutching cash and shouting orders in a sea of broker jackets and ticker screens to the same individual decades later, gray-haired and composed, monitoring algorithms in silent solitude. Through real historical events, market crashes, regulatory changes, and technological breakthroughs, viewers will understand how open-outcry trading floors, where fortunes were made through shouted orders, hand signals, and physical endurance, evolved into silent server rooms executing millions of trades per microsecond. The story examines key figures like Paul Volcker, who created the volatility that defined 1980s trading, Michael Milken, whose junk bond revolution changed corporate finance, and the architects of high-frequency trading, while exploring pivotal moments including Black Monday 1987, the birth of NASDAQ electronic trading, the 2008 financial crisis, and the 2010 flash crash. Viewers will learn about market microstructure, the mechanics of algorithmic trading, regulatory evolution from physical pits to digital exchanges, and the profound human cost of technological displacement. The central question: did we truly eliminate chaos or simply automate it into invisibility? Picture this: October 19, 1987. A trader on the New York Stock Exchange floor, arm raised high, clutching fistfuls of crumpled bills, screams himself hoarse as the market plunges 22% in a single day, the largest one-day crash in history. Around him, hundreds of brokers in colored jackets shout, shove, and panic. Paper tickets shower down like confetti. Grown men weep. The chaos is deafening, visceral, human. Now, fast forward to May 6, 2010. The market loses nearly $1 trillion in value in just 36 minutes. But this time, complete silence. The same trader, now gray-haired, wearing a tailored suit, sits alone in a glass office watching multiple monitors as algorithms battle other algorithms at the speed of light. He's helpless. It's happening too fast for human intervention. What happened between these two moments reveals one of the most dramatic transformations in financial history. That young trader waving cash in 1980 and the silver-haired analyst monitoring screens in 2025 represent the same system, but a system that has fundamentally changed. Wall Street evolved from a gladiatorial arena of human emotion, intuition, and physical endurance into a digital battlefield where machines make decisions in microseconds, faster than a human can blink. This is the story of how Wall Street went from chaos to calm, from analog to digital, from human judgment to artificial intelligence. You're about to discover what we gained, what we lost, and whether the chaos truly disappeared, or just moved somewhere we can no longer see it. Before we continue, tell us in the comments from which city are you watching, and at the end, do not forget to rate this educational documentary from 0 to 10. Enjoy the documentary. The roar hits you first, a wall of sound so dense it feels physical, like walking into ocean surf. Our trader pushes through the heavy doors onto the New York Stock Exchange floor at 8:45 a.m., 15 minutes before the opening bell, and the chaos is already building. Over 5,500 bodies packed into this cathedral of capitalism, and every single one of them is preparing for war. He adjusts his blue broker's jacket, the buy tag pinned prominently to his chest, and scans the crowd with the practiced eye of a predator assessing a hunting ground. The jacket isn't just uniform, it's identity. Blue for independent brokers, red for specialists, yellow for clerks and runners. From across the massive floor, you can read allegiances, roles, hierarchies, all color-coded in a system that's evolved over generations. The air smells of coffee, cologne, cigarette smoke, and something else. Adrenaline, maybe, or desperation. Electronic ticker boards wrap the walls, glowing amber with streaming stock symbols and prices, but the real information moves faster through human networks. He spots Tommy Chen across post 8, catches his eye, reads the slight shake of his head. Bad overnight news from Asia. Information travels at the speed of eye contact here, of shouted warnings, of relationships built over years of standing shoulder to shoulder in this controlled pandemonium. The opening bell erupts and the floor explodes into motion. IBM, what's the bid? 92 and a quarter. I'll take 5,000. Sold. The specialist at post 8 holds up 5 fingers, palm facing in. buy signal, and 3 traders converge instantly, shouting their counteroffers. Hands fly everywhere in a language more precise than words. Palms out for sell, palms in for buy. Fingers indicating quantities, one finger for 100 shares, closed fist pumping for thousands. A frantic ballet of capitalism performed at maximum volume. Our trader knows 50 people by name on this floor, recognizes 100 more by face and reputation. That matters because reputation is everything here. Your word is your bond, because you'll face these same people tomorrow and the day after. He can read panic in Marcus's eyes before Marcus opens his mouth, can sense when institutional money is moving by watching how the specialists shift their weight. When Jenny from Goldman starts shouting louder than usual, he knows she's protecting a major client position. This isn't just trading, it's reading human nature at scale, making split-second judgments based on psychology, body language, the subtle tremor in a colleague's voice. Paper tickets flutter through the air like confetti. Every trade written by hand, time-stamped, carried by teenage runners, sprinting between posts in sneakers worn thin. The specialists stand at their posts like traffic cops, maintaining order books in their heads and on paper, using their own capital to smooth out imbalances between buyers and sellers. It's an exclusive, almost medieval role, granted by the exchange, passed down through firms extraordinarily profitable and wielding enormous power over individual stocks. By lunch, our trader's voice is already hoarse, his shirt soaked through with sweat despite the industrial air conditioning, struggling against 5,000 bodies generating heat. He's made 14 trades, lost 3, won 9, broken even on 2. His feet ache, his throat burns. But he's alive in a way that no other job could make him feel, part of something larger, faster, more intense than himself. This is how fortunes are made in 1980. Through physical endurance, social intelligence, and the ability to make decisions while drowning in chaos. Information moves at the speed of shouting and running, trust is built face-to-face, and success requires thriving in the storm rather than seeking shelter from it. The ticker board flashes red, and our trader watches the prime rate climb for the 4th time in 6 months, 21.5% now, a number that would have seemed impossible a year ago. Volcker's going to kill us all, Tommy mutters, loosening his tie as bond prices crater across the board. But our trader sees something different in the chaos. The 607 former Fed official appointed by President Carter in August 1979 isn't killing them, he's feeding them. Every trader on this floor knows Paul Volcker's mandate: crush inflation running at 13.5%, no matter the cost. His strategy is radical, almost reckless by conventional standards. Instead of gradually adjusting interest rates, Volcker targets the money supply itself, letting the federal funds rate find its natural level. That level turns out to be stratospheric, hitting 20% by June 1981. Mortgage rates exceed 18%, the prime rate peaks at 21.5%. A recession officially begins in January 1980. The pain is real and everywhere. 3 banks fail in the Midwest in 1 week. Corporate bond defaults accelerate. Layoffs ripple through manufacturing. By 1982, unemployment will hit 10.8%, the highest since the Great Depression. Our trader hears the stories: colleagues losing their homes, unable to refinance at these rates, families destroyed by the recession Volcker engineered. The human cost of fighting inflation is measured in shuttered factories and breadlines. But for a floor trader who thrives on volatility, these are the best days of his life. Every Volcker speech moves markets violently. Every inflation report creates waves of panic buying or selling. He makes 7 profitable trades before lunch on a day when Treasury yields swing 200 basis points. The chaos he mastered in normal times is now amplified to levels that separate the skilled from the merely competent. Weak traders wash out. Strong ones multiply their money. He's pulling down bonuses that dwarf his base salary, riding volatility like a surfer on a hurricane wave. The floor splits into camps. Those betting Volcker will break, those betting inflation will break first. Our trader stays agnostic, playing both sides, reading the crowd's fear and greed. When yields spike, he goes long. When panic subsides, he sells. His edge isn't predicting Volcker's next move, it's reading how 5,000 other humans will react to that move a split second before they do. Then, the unintended consequences begin emerging. With interest rates at 21.5%, corporate borrowing for growth becomes prohibitively expensive. But something else becomes attractive: buying entire companies rather than building them. When your cost of capital is 21%, a company trading at depressed multiples looks like a bargain even if you have to borrow to acquire it. The seeds of the leveraged buyout boom are being planted in Volcker's high-rate environment, though few on the floor recognize it yet. By 1983, inflation drops to 3.2%. The prime rate settles around 10.5%. Unemployment remains painfully high at first, but the foundation for 2 decades of growth is set. Volcker's shock worked. He broke inflation's back by breaking the economy first, then letting it rebuild on stabler ground. Our trader's accounts are flush with profits from riding the volatility. He's proven what every floor veteran knows: central bank policy is the most powerful force in markets, dwarfing corporate earnings, technical patterns, or individual company news. When the Fed speaks, everything else is noise. The lesson burns itself into his memory. Volatility equals opportunity, and nothing creates volatility like a central banker willing to sacrifice everything to achieve his mandate. The order comes through at 9:47 a.m., $300 million in high-yield bonds for a company our trader has never heard of, and he realizes the game has fundamentally changed. Michael Milken is rewriting the rules from a trading desk in Beverly Hills, 3,000 miles from this floor, and the shockwaves are reaching New York daily. The junk bond king at Drexel Burnham Lambert has made a discovery that's transforming capitalism. Companies rated BB or below, bonds the establishment dismisses as junk, actually default far less often than rating agencies predict. Milken's research proves that a diversified portfolio of these high-yield bonds generates superior risk-adjusted returns. It's financial alchemy, and suddenly, capital flows to places it never reached before. Our trader watches the impact ripple across the floor. MCI raises billions in junk bonds to challenge AT&T's monopoly. Ted Turner finances his media empire with Milken's money. McCaw Cellular builds a nationwide network that traditional banks wouldn't touch. Hundreds of emerging companies that couldn't get investment-grade ratings are suddenly raising hundreds of millions. Capital has been democratized. You don't need blue-chip credentials anymore, just a compelling story and Milken's blessing. The junk bond market explodes from $10 billion in 1980 to $189 billion by 1989. But the real revolution is what junk bonds enable: leveraged buyouts. With Volcker's high interest rates making organic growth expensive, corporate raters discover they can buy entire companies using borrowed money secured by the target company's own assets. Our trader executes orders for deals that would have been impossible 5 years ago. RJR Nabisco goes private for $25 billion in 1988, the largest LBO in history. Beatrice Foods, Safeway, Revlon, iconic American companies bought with mountains of junk bond debt. The formula is elegant and brutal. Identify an undervalued company, borrow 10 times your equity/costs, and extract value. Debt-to-equity ratios hit 10.1, sometimes higher. The floor becomes intoxicated with the possibilities. Our trader watches colleagues make fortunes on takeover speculation. Every rumor of an LBO sends stocks soaring. Milken himself reportedly earns $550 million in 1987 alone, a number so obscene it barely seems real. The young MBAs flooding Wall Street speak a new language: leveraged recapitalizations, poison pills, green mail, white knights. Finance has become warfare, and junk bonds are the ammunition. Then the cracks appear. Ivan Boesky, the infamous arbitrageur, gets caught insider trading. Dennis Levine follows. The scandals metastasize, reaching into Drexel itself. Our trader executes fewer junk bond orders, hears whispers of investigations, watches the euphoria curdle into suspicion. In 1990, Milken is convicted of securities violations. Drexel Burnham Lambert, the 5th largest investment bank in America, files for bankruptcy. The junk bond market craters. Our trader sits at his post watching companies collapse under debt loads they can't service. The recession of 1990-91 exposes what excessive leverage always exposes. When the music stops, someone's left holding worthless paper. Companies that legitimately needed capital, Turner Broadcasting, MCI, survive and thrive. But scores of others, loaded with 10-1 debt ratios and no margin for error, implode spectacularly. He realizes he's witnessed both the power and peril of financial innovation. Junk bonds unlocked tremendous value, challenged monopolies, funded genuine growth, but they also created systemic fragility, a complex web of leverage where one default could cascade into dozens. Milken's genius was real, but so is the recklessness, the question haunting our trader. Was the innovation worth the wreckage? Capital became democratized, but at what cost when democratizing debt means spreading risk everywhere? October 19, 1987, 9:30 a.m. The opening bell rings and our trader knows within 30 seconds that something is catastrophically wrong. The Dow closed Friday at 2,246.74, down modestly after a week of jitters. This morning it opens in free fall. Every phone on the floor screams simultaneously, a sound he's never heard before. Thousands of clients calling at once, every single one wanting the same impossible thing: sell everything now. He grabs his handset and hears pure panic. Get me out, I don't care what price, just get me out. The order tickets start piling up, ankle deep by 10 a.m., knee deep by 11. Paper everywhere, runners colliding, specialists overwhelmed at their post trying to maintain orderly markets in conditions that are anything but orderly. The chaos is familiar, but amplified to nightmare levels. Traders scream bids that vanish before anyone can respond. IBM drops $20 in minutes. Blue chips trade at discounts that would be laughable if they weren't terrifying. Our trader watches a colleague, Marcus, who survived the 73-74 bear market, simply freeze, eyes glazed, unable to function. Another trader sits on the floor crying, his entire net worth evaporating. By noon, the Dow is down 300 points. By 2 p.m., 400. The selling accelerates instead of exhausting itself. This isn't normal correction mechanics. Something else is driving this. The culprit has a benign name: portfolio insurance. Institutions had programmed computers to automatically sell futures contracts when markets declined, a strategy designed to protect against losses. But the computers don't know when to stop. The feedback loop is elegant and deadly. Markets drop. Computers trigger sell orders. Selling pushes markets lower. More computers trigger, more selling, faster dropping. A doom spiral encoded in algorithms, executing without human judgment or hesitation. The machines are selling to other machines, and humans can only watch the cascade accelerate beyond their ability to intervene. By closing bell, the Dow has plunged 508 points, 22.6% in a single day. Worse than any single day in 1929. Hong Kong dropped 45.8%. Over $500 billion in market value has evaporated in hours. Our trader's voice is gone, his shirt drenched, his hands shaking from adrenaline crash. The floor looks like a war zone, paper tickets scattered everywhere. Traders slumped in exhaustion, phones still ringing with clients wanting reassurance nobody can provide. Fed Chairman Alan Greenspan issues a one-sentence statement before markets open Tuesday. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. It's enough. Markets stabilize. NYSE President John Phelan had considered closing the exchange Monday afternoon, but decided keeping it open was less dangerous than the uncertainty of closure. The post-mortem begins immediately. Circuit breakers are introduced in 1988, automatic trading halts when markets move too violently, giving humans time to think. Regulations tighten around portfolio insurance. But most floor traders, including our protagonist, dismiss the crash as a one-time aberration. Computers contributed, sure, but human judgment ultimately prevailed. Markets recovered, the system worked, the warning goes unheeded. What nobody grasps is that October 19, 1987 isn't an anomaly. It's a preview. Automated trading strategies created feedback loops that humans couldn't interrupt fast enough. The chaos was still human scale, still comprehensible, still manageable. But the seed of a darker future was planted. What happens when computers trade faster than humans can think? Our trader files that question away, relieved to survive, confident that his skills, reading crowds, making human judgments, will always be essential. He's wrong, but it will take another 23 years to prove it. The Bloomberg terminal arrives at his desk in 1992, and our trader stares at it like an unwelcome house guest, this glowing green screen promising to replace relationships he's built over 15 years. Michael Bloomberg's creation revolutionized information flow starting in 1981, but our protagonist resisted as long as possible. Real-time prices, news, analytics, all available instantly on a screen instead of through phone calls to contacts, whispered tips from specialists, the organic information network of the floor. He trusts his instincts, his ability to read faces and voices. Machines can't tell him when Tommy's nervous or when institutional money is quietly accumulating. But the younger traders flooding the floor in the early 90s live on their terminals, eyes glued to screens instead of watching the crowd. They're faster with data, slower with people. He dismisses them as inexperienced, not realizing they represent the future. Then, the electronic communication networks arrive like an invading army. Island launches in 1996, founded by a programmer named Josh Levine, who thinks floor trading is an inefficient relic. His platform matches buyers and sellers automatically, electronically, after hours when the floor is closed. No brokers needed, lower fees, instant execution. Instanet expands its institutional network. Archipelago tries to bridge electronic and floor trading. These aren't fringe experiments, they're stealing volume, and the numbers don't lie. Our protagonist, now in his mid-40s, watches his daily trade count decline. Posts start closing. Colleagues take early retirement or transition to electronic roles. NASDAQ explodes during the dot-com boom. And he finally understands what the floor is competing against. NASDAQ was born electronic in 1971, no physical location, pure network. When internet stocks mania hits in the late 90s, NASDAQ scales infinitely while the NYSE floor hits capacity constraints. Floor trading volume peaks in 1997 at 5,500 traders, then begins its irreversible decline. By 2005, only 3,000 remain. He's forced to make a choice: learn electronic trading or leave. Pride battles pragmatism. Pragmatism wins, but barely. Decimalization. In April 2001 feels like a death sentence disguised as progress. Stocks stop trading in fractions, those eighths and sixteenths that provided comfortable spreads, and shift to pennies. The average bid-ask spread collapses from 12.5 cents to 2 cents almost overnight. Retail investors save billions in trading costs. Market makers and specialists, the floor's power players, see their profit margins evaporate, but the real consequence emerges more slowly. Spreads measured in pennies are perfect for computer algorithms trading thousands of times per second. The floor's human-scale economics can't compete with machines optimizing penny-wide spreads. Regulation NMS in 2005 is the final nail. The SEC mandates a best execution. Every broker must route orders to whichever venue offers the best price across all exchanges. It sounds fair, even obvious, but it requires instantaneous electronic connectivity across fragmented markets. Orders split across multiple venues in milliseconds. Floor trading becomes physically impossible when execution happens faster than a human can shout. By 2007, electronic trading accounts for 80% of volume, up from 30% just 7 years earlier. Our trader learns to stare at screens in his late 40s, translating decades of market intuition into mouse clicks and keyboard commands. The camaraderie evaporates. He sits alone now, headset on, watching numbers instead of faces. He misses reading panic in Marcus's eyes, sensing institutional flows through crowd energy, the physical communion of the floor. But the market doesn't care what he misses. Electronic trading is faster, cheaper, more efficient. Progress doesn't pause for nostalgia. He adapts because the alternative is obsolescence. But something essential has been lost in the translation from flesh to pixels, something he suspects can never be recovered. Our trader walks past a conference room in 2008 and sees 3 physicists with MIT PhDs explaining trading strategies to executives. None of them have ever set foot on the exchange floor. He's in his mid-50s now, transitioned from active trading to an oversight role he doesn't fully understand. The firm hired these quants, quantitative analysts who speak in partial differential equations and Monte Carlo simulations instead of market feel and crowd psychology. They're building algorithms that execute thousands of trades per second, holding positions for milliseconds, sometimes microseconds. They're not looking for undervalued companies or market trends. They're hunting price discrepancies measured in fractions of a penny, leveraging speed differentials measured in millionths of a second. His 30 years of market intuition are irrelevant because algorithms don't have intuition, only mathematics. High-frequency trading has transformed markets into something he barely recognizes. The strategies have clinical names: market-making algorithms posting continuous bid-ask quotes to capture spreads, arbitrage systems exploiting identical stocks, trading at different prices across NYSE versus BATS, momentum ignition, detecting large institutional orders and trading microseconds ahead of the inevitable price move, latency arbitrage, simply being faster than everyone else to react to news. It's not trading. It's information warfare conducted at the speed of light. The infrastructure arms race makes his head spin. Firms pay exchanges over $100,000 annually for co-location, placing their servers physically next to exchange servers to reduce latency from milliseconds to microseconds. Spread Networks spent $300 million building a microwave network between Chicago and New York, shaving communication time from 14.5 milliseconds to 13 milliseconds. 1.5 thousandths of a second advantage worth hundreds of millions in profits. Other firms experiment with laser transmission between data centers. Custom hardware called FPGAs executes trades in nanoseconds, billionths of a second. The speed of light itself becomes the limiting factor, and firms hire physicists to optimize for it. By 2009, HFT accounts for 60 to 70% of U.S. equity trading volume. By 2012, over 75%. The floor is nearly empty now. Fewer than 1,000 traders remain, mostly for show. Real trading happens in server farms in New Jersey, connected to exchanges by fiber and microwave, executing strategies no human could implement manually. Flash orders, dark pools, complex order types proliferate in an ecosystem designed for machines, not people. The debate rages around him. Proponents insist HFT adds liquidity, tightens spreads, reduces trading costs for retail investors. The data supports this. Critics call it parasitic extraction, technology-advantaged front-running, instability masked by complexity. Both sides are partially right, which makes resolution impossible. Our trader stays quiet during these debates because he knows his opinion doesn't matter anymore. He's a relic monitoring systems built by people half his age who've never experienced the floor's chaos. Knight Capital's disaster in 2012 validates his deepest fears. A software glitch causes $440 million in losses in 45 minutes. The firm nearly collapses before emergency financing arrives. 45 minutes. He remembers when $440 million in trading would take weeks, involving hundreds of humans making thousands of decisions. Now it happens accidentally, faster than humans can detect and stop. He sits alone at his desk, watching screens display algorithmic activity he doesn't fully comprehend. The community is gone. Trading is code running on servers in climate-controlled data centers. His colleagues are programmers who socialize on Slack, not specialists he knew for decades. When microseconds equal millions, 30 years of experience equals nothing. The machines have won, and he's become a museum curator in a world that no longer needs what he knows. May 6, 2010, 2:32 p.m. Our trader sits in his office monitoring multiple screens when the numbers start moving wrong, accelerating downward in ways that trigger memories of 1987 but feel fundamentally different. He's in his early 60s now, gray creeping through his hair, relegated to oversight and analysis. The day has been unremarkable until this moment. Then, at 2:32, the Dow begins sliding faster than normal market mechanics should allow. By 2:42, it's not sliding. It's plunging. His screens show blue-chip stocks trading at prices that can't be real. Accenture flashes $0.0 Sotheby's $0.1. Apple briefly shows $100,000. The Dow drops 600 points in minutes, then 800, then nearly 1,000. He grabs his phone, calls his contact at the NYSE. What's happening? The response chills him. We don't know. It's moving too fast. This isn't 1987. In 1987, he could see the panic in colleagues' eyes, hear the desperation in voices, understand the human fear driving the cascade. This is different, sterile, silent, incomprehensible. His screens show volume spiking to unprecedented levels while liquidity vanishes. Algorithms are canceling orders faster than new ones arrive. The market is executing millions of trades with no human buyers or sellers, just machines playing hot potato with positions they're desperate to exit. He watches helplessly, unable to intervene, unable even to understand what he's witnessing in real time. 36 minutes. That's how long it takes. By 3:08 p.m., the market has recovered most losses. The Dow stabilizes. His screens return to something resembling normalcy. But he's shaken in a way 1987 never shook him, because at least in 1987 he understood what was happening. This was chaos beyond human comprehension, executing at machine speed. The SEC and CFTC investigation takes months. The September 2010 report reveals a cascade that sounds almost mundane in hindsight. Waddell & Reed, a mutual fund, executed a $1 billion sell order in E-mini S&P 500 futures using an algorithm. Not unusual, except the algorithm didn't account for market conditions. High-frequency trading firms detected the unusual volume, bought the contracts, then immediately tried selling them to other HFT firms. The hot potato effect created a feedback loop. Volume exploded while actual liquidity disappeared. Automated systems triggered stop-loss orders. More algorithms withdrew from the market. The free fall accelerated. Circuit breakers finally halted some trading. When algorithms restarted, prices normalized. The entire trillion-dollar evaporation reversed in minutes. The human experience was helplessness. Traders across Wall Street watched screens in horror, calling each other, asking variations of the same question: what's happening? Nobody knew. The crash happened too fast for human analysis, let alone intervention. This wasn't panic. It was automation running wild, algorithms interacting in ways their programmers never anticipated, creating emergent chaos that no single person or institution could stop. The aftermath brings new circuit breakers for individual stocks, limit up, limit down rules. Exchanges establish protocols to cancel clearly erroneous trades. Scrutiny of HFT intensifies, but the fundamental vulnerability remains because algorithmic complexity creates unpredictable interactions. Markets are now systems of such intricate interdependence that no regulator can model all possible failure modes. Our trader sits alone in his office after 3:08, the crisis over, but the implications just beginning to register. The profound irony crushes him. The calm electronic markets, supposedly more stable than the chaotic floor he knew, just produced a crash far faster and more bizarre than anything in the floor trading era. Black Monday in 1987 was terrifying but comprehensible, human fear creating human chaos. This was incomprehensible, machine logic creating machine chaos at speeds humans can't process. He finally understands the truth. We didn't eliminate chaos. We automated it into invisibility, compressed it into microseconds, encoded it into algorithms. The chaos is still there, we just can't see it until it explodes. Our trader walks onto the NYSE floor in 2022, and the silence hits him like a physical force. Where 5,500 voices once roared, fewer than 500 remain, and most are here for the cameras. He's in his late 60s now, silver-haired, wearing a suit instead of a trading jacket, because there's no reason for jackets anymore. The vast space feels cavernous, empty, haunted by the ghosts of what was. Most posts are closed, dismantled, replaced by open floor space that serves no function except to remind everyone what used to be here. The few remaining traders cluster around options posts, the last refuge of human trading, because options complexity still requires human judgment for certain strategies. But even that's fading. Electronic options trading grows every quarter. He walks past Post 8 where he made his first trade in 1980, where he and Tommy and Marcus battled through Volcker's volatility and Black Monday. The post is gone. A clean floor remains. Museum-like silence. Where did everyone go? The question haunts him. Many retired early, specialists in their 50s whose posts closed, their expertise suddenly worthless overnight. Danny Garcia, who ran the IBM specialist post for 23 years, retired at 58 when his position was eliminated. 30 years of institutional knowledge about how IBM traded, how its order flow moved, which clients were significant, all made obsolete by algorithms in 2007. Some retrained. Michael Chen learned Python at 52, became a programming consultant, now teaches algorithms what human market makers knew intuitively. It's lucrative, but strange, encoding human pattern recognition into mathematical rules. Others left finance entirely. Sales, consulting, education, their social intelligence and relationship skills transferred. But it wasn't the same. And some simply disappeared, unable to adapt, careers ended prematurely, skills obsolete in a world that moved past them. The new traders aren't traders in any sense he recognizes. They're quants with PhDs in mathematics and physics, programmers optimizing execution algorithms, data scientists backtesting strategies with machine learning. No need for social intelligence, reading faces, physical stamina, or the ability to make gut decisions under pressure. Just mathematical sophistication and coding ability. They sit in quiet offices staring at screens, never meeting the people on the other side of their trades, never building the relationships that once defined this profession. The cultural loss is what destroys him most. Mentorship disappeared. No more older traders teaching younger ones through apprenticeship, sharing war stories, explaining market field developed over decades. That intuition, the ability to sense when something feels off, to read order flow and detect institutional activity. Algorithms replaced all of it, but something was lost in translation. The community dissolved. He used to know 100 traders by name, understand their tells, predict their moves. Now he knows programmers he's never met in person, communicating through Slack and email. The rivalries were real, but so were the friendships, the shared experiences of surviving crashes and celebrating wins, the culture of the floor that gave meaning beyond profit and loss. The ceremonial functions remain: opening bells for IPOs, closing bells for TV cameras, CNBC broadcasts from a corner of the floor, maintaining the illusion that this is still the center of American capitalism. But everyone knows the real trading happens in server farms in New Jersey, connected by fiber optic cables and microwave networks to exchanges that exist as electronic networks, not physical places. He adapted, learned screens, survived longer than most. The efficiency gains are measurable and real. Spreads tightened from 12.5 cents to fractions of pennies. Trading costs collapsed, access democratized, but standing in this empty cathedral of capitalism, he wonders, did we optimize away something valuable? The floor was inefficient, but it was human. It was community, culture, a way of life. Progress doesn't pause for those left behind, doesn't account for intangible losses. We gained speed and lost connection. We gained efficiency and lost wisdom. The numbers say we won. The silence says we lost something we can't measure. 2025. Our trader sits alone in a glass-walled office, gray hair perfectly combed, navy suit impeccable, surrounded by 6 glowing monitors displaying algorithmic activity he oversees but doesn't fully control. The current landscape would be unrecognizable to his younger self. Passive investing dominates. Index funds and ETFs hold over $10 trillion tracking markets rather than trying to beat them. Robinhood and Webull enabled commission-free trading and fractional shares, democratizing access so completely that teenagers trade options on smartphones during lunch breaks. 80 to 90% of volume is algorithmic. Traders work from home or anywhere. Physical presence is quaint, unnecessary. Trade execution happens in microseconds. Settlement moved to T+1, heading toward T+0. Information that once traveled at the speed of shouting now moves at the speed of light. The efficiency gains are undeniable. Average bid-ask spreads collapsed from 12.5 cents in 2000 to fractions of a penny today. Commission-free trading eliminated barriers. Anyone with a smartphone can access markets that once required floor connections and minimum account sizes. Price discovery happens faster than humans can perceive. Arbitrage opportunities vanish in microseconds. Real-time data, analytics, research, all available to retail investors who once relied on brokers for information. By every measurable metric, markets improved, but he monitors those 6 screens and sees what the metrics miss. Flash crashes persist. August 24, 2015, when ETF pricing malfunctioned. March 9, 2020, when COVID panic triggered circuit breakers, smaller events occurring monthly that barely make news. Market concentration terrifies him. The Magnificent 7 tech stocks dominate indices, creating risks nobody fully understands. The passive paradox haunts him. If everyone indexes, who performs price discovery? Markets need active traders to be efficient, yet passive investing grows relentlessly. Algorithm opacity means strategies run in dark pools beyond regulatory visibility. Systemic fragility lurks in interconnected algorithms that can cascade failures faster than human intervention. His daily reality is isolation. He sits alone monitoring screens, overseeing strategies built by programmers half his age who've never experienced the floor. Occasionally, he intervenes when patterns feel off, but algorithms usually ignore human intuition. The math doesn't account for gut feelings. He remembers the noise, energy, camaraderie. The floor was inefficient, but alive. This is efficient, but dead. Is this better? The question haunts him. The philosophical questions multiply with age. Are markets still discovering fair prices when algorithms just respond to each other's algorithms, creating feedback loops detached from underlying value? Did we trade systemic stability for microsecond efficiency? Is there still a role for intuition, experience, wisdom, or only mathematics? What do we lose when traders never see each other, never build community, never pass down knowledge that can't be coded? The floor's chaos was visible, loud, understandable even when terrifying. Today's chaos is hidden in code, silent, incomprehensible until it explodes. The future accelerates beyond his comprehension. AI and machine learning create algorithms that learn and adapt autonomously, beyond programmer control. Quantum computing could make today's HFT look glacial, enabling strategies impossible to regulate. Blockchain promises instant settlement and decentralized exchanges. Central bank digital currencies might reshape everything. Traditional exchanges might become obsolete. Markets could become fully decentralized peer-to-peer networks. He won't live to see where this ends, but he fears it. The numbers tell one story. 10 billion shares traded daily, algorithmic trading at 80–90%, fewer than 500 floor traders remaining, holding periods measured in microseconds for HFT and years for passive investors, minor flash crashes monthly. But numbers miss the essential truth he's learned across 44 years. We didn't eliminate chaos, we compressed it into time frames humans can't perceive. We didn't make markets more stable. We made volatility invisible and instantaneous. We didn't remove human emotion. We encoded fear and greed into algorithms that now trade at machine speed, amplifying everything. The calm is an illusion. The chaos remains, just hidden in milliseconds, buried in code, incomprehensible until disaster. He thinks about 1987, the screaming, panic, humanity. That chaos was terrifying but comprehensible. Today's chaos happens in microseconds, in code he doesn't fully understand. Progress? Absolutely. Better? He's genuinely uncertain. The journey from chaos to calm is really a journey from visible to invisible, from human to machine, from community to solitude. We gained speed, efficiency, access. We lost connection, intuition, transparency. Whether that trade was worth it depends on what you value, and the market stopped asking that question decades ago. This was the story of Wall Street's transformation, but it's also the story of every industry being reshaped by technology, from chaos to calm, from human to machine, from visible to invisible. In 1980, a trader needed to read faces, understand psychology, build relationships, endure physical chaos. In 2025, success requires mathematical models, programming skills, algorithmic strategies, and an acceptance of isolation. We gained efficiency, accessibility, and speed. We lost community, intuition, and perhaps something harder to measure, the human element that made markets not just mechanisms for price discovery, but arenas of human ambition and connection. The chaos didn't disappear. It moved into code running at the speed of light, compressed into microseconds we cannot perceive. The calm is an illusion. Wall Street's transformation asks us, what do we value? Efficiency at any cost, speed without limits, or something slower, messier, more human, but perhaps more stable? There's no going back. The floor is empty. The algorithms are in control. But understanding how we got here, from that young trader clutching cash and pandemonium to that gray-haired analyst monitoring screens in silence, helps us ask better questions about where we're going. The real question isn't whether we eliminated chaos. The question is, can we see the chaos we've created before it's too late?